All right, welcome to the Explainer. Today, we are jumping right into the deep end, the high stakes, high reward world of quantum computing stocks. The critical Q3 2025 earnings reports are dropping as we speak. And you know what that means? We're about to see who's turning science fiction into actual hard revenue. So, as we dive into this earnings season, there is one massive question hanging over everything. Is this whole quantum sector the next tech boom? Or is it a bubble just waiting to burst? Right? The hype is off the charts, but is it justified? Well, these Q3 numbers, they're going to give us our best clue yet.
And this number right here is why everyone is paying attention. 341%. Let that sink in. That is the staggering year-to-date gain for just one of the pure-play quantum stocks, D-Wave. A number like that, it just perfectly captures the wild, speculative energy we're seeing in this space.
Okay, so what's all the fuss about? It all comes down to this little thing called a qubit. Think of it as the building block of quantum computing. Now, unlike a regular computer bit, which is just a 0 or a 1, a qubit can be both a 0 and a 1 at the same time. I know, it sounds like science fiction, but that superposition is what lets these machines make calculations that are exponentially faster than anything we have today. It's a total game changer.
And you know what that scientific advantage leads to? A full-blown quantum gold rush. Seriously, we're talking about a market that some analysts think could explode, and I mean explode, to $65 billion by 2030. When you see that kind of growth potential, you can see why Wall Street just can't look away. Okay, so let's meet the contenders. If you're looking to invest, you gotta understand that two really distinct strategies have emerged. You can't just lump all these companies together. They're playing totally different games. So on one side, you've got your pure plays. These are the nimble startups like IonQ, Rigetti, D-Wave. They're 100% focused on quantum tech. Think high growth, but also high volatility. It's a roller coaster. Then on the other side, you've got the big tech giants, IBM, Alphabet, Microsoft. For them, quantum is just one division inside a massive diversified empire, much more stable, but maybe less explosive growth. It's a classic tortoise versus hare situation. All right, let's get to the main event, the Q3 earnings test. This is where the rubber meets the road. Can all this incredible promise finally translate into actual profit? First up, let's put a spotlight on a pure play, IonQ. These guys are pioneers in what's called trapped ion quantum computers. And their Q3 report, it's one of the most anticipated of the season for sure. Everyone is watching to see if their revenue is finally starting to catch up to their amazing tech. And just look at these numbers. The forecast for IonQ's Q3 revenue is wow. Analysts are expecting a jump from about 11.7 million last year to 27 million this year. That is a massive 130% year-over-year surge. We're not talking about a little bit of growth here. This could be a real breakout moment for them. So you might be asking, where's all this growth coming from? Well, it's not just hype. It's being driven by some really big, concrete deals, like a $22 million deal for America's first quantum hub. They've got a new quantum chemistry partnership. And get this, they already have $95 million in future bookings lined up. Plus, they're making great progress on their new Aries processor. This shows their progress is real, not just something in a lab. Okay, so while the pure plays are duking it out, the big tech giants are playing a completely different game. Let's switch gears and look at IBM. They just dropped their Q3 numbers, and their whole strategy is about weaving quantum tech right into their huge cloud business. And here's where you see the scale difference. $16.3 billion. That was IBM's total revenue for Q3. So their quantum division, it's a tiny, tiny piece of that much larger puzzle right now. But, and this is the important part, it's the piece they believe is going to drive their future growth. And, buried deep inside their earnings release was this little gem, a quote about a quantum breakthrough that could slash error rates. Now, that might sound boring, but trust me, it's a huge deal. Error correction is one of the biggest roadblocks for quantum right now, and this is a massive step toward making these machines actually useful for real-world stuff. All right, you can't talk big tech without talking about Alphabet, right? Google's parent company. And they also just posted a monster quarter. What's really interesting is how they're highlighting the connection between their AI work and their quantum research. And look at this number, $102.3 billion.
Alphabet didn't just meet expectations, they smashed them. It was their first ever quarter with over $100 billion in revenue. Think about that. With that kind of cash, they can pour basically unlimited resources into long-term projects like quantum.
And here's the kicker. Their quantum team is housed inside Google Cloud, and that division's revenue jumped 35% to over $11 billion. The CEO, Sundar Pichai, even pointed to its use in things like climate modeling. So this isn't just some far-off research project anymore. It's actually helping them win business today.
Okay, so we've seen the pure plays, we've seen the big tech giants. What does this all mean for you, the investor? Let's put together a little playbook for how to navigate this exciting, but yeah, pretty volatile market. This table does a great job of laying it all out at a glance. You can see the year-to-date gains. I mean, D-Wave at 341%, Rigetti at 190%. Wild stuff, but also high risk. Then you've got IBM and Microsoft, chugging along with solid 20–25% gains, much lower risk. It really shows you that spectrum of choice. But hey, before we all jump in, we have to be realistic about the risks. And there are some big ones. The hardware still has high error rates. There's a global shortage of actual quantum experts. You've got geopolitical tensions, chip controls. Oh, and the pure play startups, they are burning through cash like you wouldn't believe.
So what's the playbook here? Well, analysts seem to be pointing to 3 key steps. Step 1, diversify your bets. Don't put all your eggs in one basket, right? Mix the pure plays and the big tech. Step 2, watch for those post-earnings dips. The volatility can create some really nice buying opportunities. And step 3, and this is probably the most important one, think long-term.
Here's one specific strategy that's being floated, a 60-40 split. The idea is you put about 60% of your allocation into the more stable, big tech companies, and then take a shot with the other 40% on those higher risk pure plays. It's a way to balance that stability with that moonshot potential. And really, if there's one thing you take away from this, it's this. Remember that this is a long-term game. We're not talking about a get-rich-quick scheme. The experts are suggesting a 3 to 5 year holding period because true commercialization is probably still a few years out, maybe around 2028. So patience is key.
So look, as these Q3 earnings reports make crystal clear, the future of computing is getting here way faster than most people think. The tech is maturing, the revenues are starting to kick in, and that leaves us with one final question. The quantum revolution is here. The only question is, will your portfolio be ready?